Hello, this is Joe Pryor of the virtualrealestateteam.com in Oklahoma City. You know, I've had a lot of training in investment real estate, both in residential real estate and commercial real estate. You know, and the one thing that if you take this kind of investment training on both sides, they're going to drill into you two things: active income, passive income. So if you're a doctor, you're an attorney, you're an insurance person, whatever you happen to be, you earn a living from what you do. That is active income. But on the other side, there is something where you can make investments, like in real estate. That is considered passive income. It's treated separately when you do your tax return. But what I want to talk about today is something that people just don't realize. And that is passive income is a lot more valuable than you think it is. Now, if you have active income and you're paying taxes on what you make. But if you're making money in passive income, you're not necessarily paying taxes on what you make. Here's the deal. Passive income has some offsets. So let's say you get yourself up to $10,000 a month passive income through investments, through primarily real estate investments. Well, if it's residential real estate, we take the improvements, we take out the land, we take the improvements, we divide it by essentially 27.5 years, divide that by 12, and that's how much write-off you have every month based on what they call depreciation of the improvements. You don't depreciate land, but you appreciate improvements. And so if you have $500 a month positive cash flow and you have $450 a month in terms of depreciation, your taxable event is basically going to be $50. Now, I'm not a CPA, so don't hold me to exact numbers, but essentially that offsets profit that you're making that you can take off that investment. Now, there's also rules about making improvements to the home, making repairs to the home in terms of long term, and these go on forever. I mean, they just don't end. And so you can take those as you need them. And if you don't use them all in the year that they happen, because it's a longer depreciation schedule in terms of improvements, for instance, you can still use those in the second year and the third year and the fourth year. So essentially, think about it as this. If we do this investment right, if we make sure that the land cost is not too high, and that's the advantage of Oklahoma. You may be in California where the land costs are 60%, 70% of your investment, whereas in Oklahoma it may be 15%, 18%, then we can deliver a lot more depreciation to you, plus your improvements. Essentially, like in my business, because I'm a self-employed person, $10,000 a month is more the equivalent of at least $25,000 a month if I was actively earning something in the real estate industry for the expenses I have as a self-employed person and the taxes that I pay. So at my age, which is essentially retirement age, having $10,000 a month positive is like making $25,000 a month. And so isn't that what we want? Isn't that the comfort that we want? Now, if you look at some of my previous videos, and I'll probably do another one on 1031 tax-deferred exchanges, when you sell real estate, you can avoid taxes by reinvesting it. It's something I've done for a lifetime that I'll do to the end of my days. Because I want that passive income and the advantages that come with it. So if you want to know more about this, about investing in real estate and getting that benefit and making your income go a whole lot farther, just call me. This is Joe Pryor of the virtualrealestateteam.com in Oklahoma City, where we deliver traditional real estate values at the speed of technology.